I think overstaying my welcome has been one mistake, which is to say it's a contrarian business. And I've been pretty good about buying when other people weren't buying. I haven't been as good at selling when other people began buying, which is to say that I have often forgotten that markets work. And I would say that's been my most common mistake. Well, one of the examples would be the junior uranium stocks. 3 years ago, they were effectively free. And any public forum that would allow me, I'd pound the pulpit on them. Possibly because I talk too much, but the uranium price helped too. These stocks went from being free to being stupidly expensive. And the consequence of that was that I sold at one point in time approximately 80% of my junior uranium portfolio. I thought the price of uranium had to go to 60, but the stocks were acting like the price had already gone to 70. And the consequence of that is you try in your own mind to construct an admittedly imperfect model of what a company might be worth in various pricing scenarios. And if the market capitalization of the company exceeds what you think it might be worth at a commodity price that they haven't achieved yet, you need to sell some stock. My second most common mistake has been to do too much. Particularly when times are good, the clients have asked me to find more and more opportunities for them. And there is a scarcity of good opportunities. There are times in the market when the right thing to do is nothing, absolutely nothing. And doing nothing is hard, particularly when thousands of people are relying on you for their retirements. I look particularly in the speculative parts of my portfolio, Jack, where people are more important than assets. I've had the good fortune to be very close to probably 24 serially successful natural resource entrepreneurs. And what you learn is that a very few people generate most of the success in the investment business. And to be honest with you, had I confined myself to investing with people who I had already been successful with by the time I was age 35, and never investing with one more newcomer ever after that, I would have made twice as much money and I would have worked a quarter as hard. Which is interesting. It really, truly is interesting. One thing that I have done right is I've always been more of an arithmetically oriented than a narrative oriented investor. So while most people were overcome with fears of uranium because it hadn't performed, I looked at a commodity that was necessary for the ascent of humankind, that cost $60 a pound fully loaded to produce, including cost of capital, and was selling for $20. I looked at a commodity where either the price had to go up or the lights had to go out. I didn't care about the narrative. I just knew that people wanted to stay warm and have the lights go on. So uranium was fairly obvious to me. Similarly, 2 years ago, when COVID took the oil price down to sub-zero, or for months at between $20 and $30 a barrel, it was very clear to me that the oil price had to go to 60. It had to go to 60. Greta Thunberg notwithstanding, it had to go to 60. So I've been pretty good about that. And I've been pretty good, too, at understanding that money is made by compounding. That isn't just one thing that has to go right. That one thing has to lead to another thing, which has to lead to a third thing. And if you have a time frame expectation around your investments that's unrealistic, your expectations are unrealistic. While many investors have trauma holding stock over a long weekend, I would say that my average successful holding period is between 5 and 6 years. And sometimes much longer, much longer. So I think I've done things right and I've done things wrong. Having been on Earth now 69 years and being involved as an active investor for 49 of those 69 years, I'm getting better at segregating what I do well with what I do poorly. And one consequence of that is that when I was younger, when I enjoyed success in my 20s, I came to believe wrongly that the success that I enjoyed in certain facets of investing translated over into other industries. In other words, I entered areas where I didn't have a durable competitive advantage. I learned that I wasn't that smart. And so in retirement now in particular, I confine my investments to natural resources and conventional financial services, which I understand well. I'm not interested in media stocks. I'm not interested in retail. I'm not interested in crypto. I'm not interested in anything that I don't understand intimately and where I don't have a variety of contacts who can help me understand those things that I don't know. One of the things I see in the resource space now is a real true plethora of opportunity. I see impending supply shortages, albeit with that huge caveat about a recession. At the same time that I see declining share prices, which is to say the price of admission to an increasingly attractive opportunity is going lower. And interestingly, it's going lower across the whole value chain. I cut my teeth and became well known in smaller microcap speculative stocks. And I've been priced out of that market for 3.5 years. In other words, I've been priced out of the market that I do the best at. But now those stocks are collapsing in price. And so the specialty that I cut my teeth in, which is private placement transactions in debt and equity among junior resource stocks, has suddenly lost its favor, which means to me it's suddenly become much more attractive. So I'm looking forward to a circumstance where the next 12 to 18 months is going to be very, very rewarding for me. Rewarding psychologically because I do what I like to do, and rewarding financially too, because the price of admission to an increasingly attractive industry is going down.
Would you say that the odds that of them being successful are slim if they don't truly love it?
I mean, absent luck, I'd say they're nil. People misconstrue what stocks are. They sort of act as though they're ticks on a computer screen. They represent fractional ownership in businesses. And if you don't have enough expertise to understand at least something about what the business is worth and might come to be worth in a certain circumstances of, probable occurrences, you have no business owning the stock. That's precisely why, despite the fact that I have a lot of generalist experience in credit, in income statements, in balance sheets, in redundant asset analysis, all the stuff that generalist investors do, it's one of the reasons why I pretty much confine myself to the natural resource and conventional financial services ghettos. I've learned that despite the fact that I have good generalist education and instinct, I do better confining myself to areas where I can outcompete my competition. Focusing on the firm has been much more important for me. Now, it's important for your listeners to note that a lot of my history was an exploration where finding something of value was more important than the price that it might obtain. I'm lucky enough to have been part of a couple of dozen tier one discoveries where the price of the commodity became much less important than the fact that a series of drill holes answered some unanswered questions. And the prize for getting a yes answer was a multi-billion-dollar discovery. But I would suggest that you need to be able to do both. I would suggest that you need to be able to compile a shopping list utilizing your expertise, and then you have to have the discipline to exercise your check rating skills when other investors are on strike. And you probably need a third discipline, which is to say when the market turns in your favor and the world suddenly believes that you're smart, rather than taking that to heart, you need to begin to sell off your portfolio. There are 12 uranium juniors out there that I think at $70 uranium, which I now think is probable, that I think have reasonable possibilities and in some cases probabilities of delivering shareholder value. And so I have a list of 12 companies that in the right set of circumstances I'd like to buy. I monitor the companies for any changes in their condition that might cause me to raise or lower my expectation of their value 3 years from now and 5 years from now. And then I try to rank them in terms of relative attractiveness, A, and B, what I'm trying to cause to occur in various parts of my portfolio. And I'm looking again to increase my shareholdings in the junior uranium sector, even while they're falling off fairly hard.